Good afternoon, it's Brian Shannon from AlphaTrends.net. Today is Wednesday, the 8th of October, 2008, and we had an extremely volatile session here today. You can't see it here on this chart or even on the 1-minute time frame, but pre-market, the Federal Reserve did cut interest rates by 50 basis points. That had the S&P 500 up significantly, and then they caved in, opened on a gap lower actually, and then started to rally immediately. The market came back below the VWAP, and then later on in the afternoon it looked like it was going to start to advance again. I had posted right here at 1:35 p.m. that I thought that maybe this was the beginning of a rally as it was holding the 1-minute VWAP, but obviously we know what happened in there, and hopefully you were watching those intraday updates, because I said basically that you wanted to get out I'll talk about that when we take a look at the cues. But here, obviously, the S&P 500, we had massive volume in here today. Not quite the biggest volume this year, but there's just all this volatility and volume, which leads me to believe that we're getting closer to a turning point, but it's such high risk that it's really only for the most aggressive, most disciplined day traders. This is truly a great environment to be a day trader in if you're disciplined. If you're not disciplined, it's going to be a massive lesson in frustration. Here's the appeal of catching a bounce. This is the Dow Jones Industrial Averages from 1929 through 1933, and you can take a look at this much clearer at AlphaTrends.net. But basically, there were 8 large declines here during this period of time. Notice also this orange moving average is the 200-day moving average. This, as long as the market's below a declining 200-day moving average, any rally is guilty till proven innocent. You see here, it wasn't until first quarter of 1933 that the market actually turned back above there, made a higher high, we had a higher low, and then it began to rally. But some of these rallies during the decline were 52%, 19%, 27, 30, 39, 28, 100%, and they were pretty short term in terms of the time they took to develop. And that's the appeal of trying to pick a bottom in here or trying to catch a turn, because realistically it just seems like, well, how much further can this decline? And we get our answer at the end of each day when we finish lower once again. S&P 500 today down $1.93, just close to 2%. We continue to obliterate every level of what appeared to be support at one time. And again, potential support levels are only an area where you want to look at the market on a shorter time frame. Look to see if there's evidence that the buyers are starting to take control. Enter and then manage risk. Risk management is always job number one. So depending on the feedback I get from those posts today, I'm not sure I'm going to get that involved with trying to pick a turn for people. Hopefully no one got hurt. You shouldn't have if you were disciplined about getting into the market. You didn't get overexcited and were willing to get out of it when the market action dictates. You have to listen to the message of the market. World financial markets continue to get destroyed. The EFA was down another 2.25%. No support in here. I mean, you look at this level, you could look at this prior level of resistance, maybe going to act as support, but that's only potential area where the buyers may take control. I talk a lot about it in my book. That's what my book is about, technical analysis using multiple time frames. So take a look at that. But oil today was also down 26 cents. You can see the 5-day moving average market starting to just turn sideways enough that this 5-day moving average is catching up to it. Maybe this market can get a rally if it clears that, but still on the daily time frame, very much in a clear downtrend. That downtrend remains uninterrupted here, but perhaps getting above 74, if the 5-day moving average flattens out and that sort of thing, we can get a similar tradable rally. But it's only a tradable rally, and how you handle the risk in there. I got out of all my longs today. I am holding some call positions just in case the market melts up. In case it melts up. I probably should have bought puts actually, but I have them at a profitable position, and hopefully they'll continue to remain so. But buying call options is the only only way that I can strictly manage the amount of risk that I take. Buying the underlying exposes me to unknown risk and unknown potential market losses. The Russell 2000 was down $1.34 today, and getting closer to that $50 price objective from the Head and Shoulders pattern. It seems, a week ago I said it seems like it's in a very aggressive target, and it seemed like I said that because I thought it was a very aggressive target, but it's heading towards that level, and perhaps that's where it ends up. But again, it's guilty till proven innocent. The only way that you want to be looking to trade this market is on the very short-term time frames. The 1 minute time frame, here's that, at 1:35 p.m. it started to turn in here, but then as it breaks through support, you gotta listen, respect price and move to the sidelines, because nothing else pays, and the risks remain very large, obviously, in this market. Paulson said they're going to throw everything they have at this market, at these markets to promote stability, and still they sold off, basically on those comments at the end of the day. Nasdaq 100 was down on big volume. It was down 26 cents or 0.8%. Again, it's just getting more and more oversold. Oscillators, indicators, everything's diverging and saying oversold, but oversold and divergences aren't reasons to buy. They're only reasons to look at potential areas where the market may be finding support, and that's what the shorter term time frames are. Anyone who is a swing trader or any period longer should not be looking at making purchases in this market until we at least get above this 5-day moving average. That 5-day moving average flattens out, and we start to break trend lines and break past levels of resistance and start showing higher lows. Those signs aren't there yet. They appeared to be there once again today here on the Qs. We saw that the market did rally from that level, and you have to manage risk. It made a lower high right here, a lower low right here, lower highs. It looked like it was going to go, but then from this failed little move here came the end of the day crush. And what I was saying was that it really needed to hold above this 2-day VWAP. And if you're still holding, you're playing a different game than I am, that's for sure. And mine is centered around managing risk first and foremost. Hopefully, again, that's where your concentration is as well.